All right, welcome to the Explainer. Let's just dive right into what is honestly a fascinating world: real estate taxes. We're going to take what looks like a ridiculously dense, boring IRS code and transform it into a practical, highly rewarding guide for your absolute biggest asset. Whether you're buying a place, selling it, renting it out, or even just working from home, the tax implications we're going to cover are absolutely massive. So here's the ultimate question we've got to answer today. Is your house actually an investment, or is it a tax trap? Seriously, understanding exactly how the IRS views your home is the difference between keeping your hard-earned money and facing an incredibly expensive audit. Now, the government generally really likes individual homeownership, so they offer deductions that are completely unavailable to renters. But as you'll see, you have to play strictly by their rules if you want to reap those rewards. To make all these abstract, kind of dry tax laws actually feel real, we're going to follow Tyler and Jasmine Jefferson on their financial journey. So Tyler is a newly hired VP making $320,000 a year, and Jasmine is a graphic designer earning $37,000. Right now, they're selling their home in Denver, they're moving to a bigger place in Chicago, they're eyeing a really nice vacation property down in Scottsdale, and Jasmine is launching a home-based business. We are going to look at how the tax code impacts every single step they take. Okay, let's get into Section 1, the rules of residence. Basically, defining your home. See, before the Jeffersons make any moves at all, we have to realize something absolutely crucial. The IRS, they don't care about your feelings or your emotional attachment to a house. They think in very rigid math formulas. In fact, they categorize your dwelling unit based strictly on a 14-day or 10% math equation, and this completely dictates your tax deductions. So a principal residence is your main home. It's where you spend your time, where you work, where you get your mail. But a secondary unit? That's only considered a residence if your personal use exceeds the greater of 14 days or 10% of the days you actually rent it out. If it doesn't meet that, the IRS slaps a non-residence label on it, meaning it's treated as a pure rental property. Moving right along to Section 2, selling your principal residence, and more specifically, tax exclusions. Okay, look at this number, $500,000. When Tyler and Jasmine sell that Denver house, they don't necessarily have to pay capital gains taxes on the profit. For married couples filing jointly, that tax-free exclusion is a massive $500,000. For single filers, it's $250,000. It's a huge, huge windfall, but you know the IRS doesn't just hand this out to anyone? Right, to grab that $500,000 tax-free check, you've got to jump through their hoops. You have to pass two very strict tests to prove you aren't just a real estate investor flipping a property. First is the ownership test. You have to own the property for at least 2 of the last 5 years. Second is the use test. You have to actually live in it as your principal residence for at least 2 of those 5 years. And notice this absolutely critical detail for joint filers: only one spouse needs to meet the ownership test, but both spouses must meet the use test. Now, you might be wondering, what if life just happens? Say Tyler gets transferred to Miami for work after living in the Denver house for only 7 months. Do they lose that tax benefit entirely? Well, actually no. Under the unforeseen circumstances provision, things like sudden job transfers or health emergencies actually allow you to claim a prorated exclusion. You basically just divide your qualifying months by 24 to get a reduced maximum exclusion, so they might still walk away completely tax-free. All right, Section 3, mortgages and property taxes. Let's talk about deduction limits. So the Jeffersons are buying this new $800,000 place in Chicago, right? Well, that triggers a really important IRS cap. See, you can only deduct interest on debt that's used to acquire or substantially improve your home, and the IRS caps that limit based exactly on when you bought the house. It's called acquisition indebtedness. If you took out your loan before December 16, 2017, you can deduct interest on loans up to $1 million. But for Tyler and Jasmine buying their Chicago home today, that limit strictly drops to $750,000. Any interest they pay on a loan balance above that $750K mark, it simply isn't deductible, period. Now, what if they want to buy down their interest rate using mortgage points, basically paying extra cash up front for a lower rate? Well, they need to run this exact mathematical sequence to see if they'll even live there long enough to actually save any money. 1 point equals 1% of the loan principal. Since they are deductible if paid to lower the rate on a principal residence, you've got to compare the after-tax upfront cost against the after-tax annual interest savings. Doing that math calculates your break-even point in years and tells you if it's actually worth the upfront cash. 10 grand. That's it. That number represents the absolute maximum you can deduct for all your state, local, and real property taxes combined. It's known as the SALT cap. So even if the Jeffersons pay $8,000 in property taxes on their new Chicago home and let's say $15,000 in state income taxes, their total itemized deduction for all these taxes hits a hard brick wall ceiling at $10,000. This is a notorious trap that catches so many new homeowners completely off guard during tax season, especially if you live in a high-tax state. Which brings us to Section 4, the vacation home tax trap. It's all about rental versus personal use. Okay, so Jasmine talks Tyler into getting a sweet vacation spot down in Scottsdale, but renting it out, that creates a crazy complex tax maze. Listen to this story from our source about two neighbors, Carrie and Pat. Both of them rented their upscale golf homes to tourists for exactly 14 days, and both pocketed over $14,000 totally tax-free. But Pat decided to let his renters stay just one extra day for another $2,000. By crossing that 14-day threshold and hitting 15 days, Pat suddenly had to report all his rental income to the IRS, while his neighbor Carrie paid absolutely nothing. One single day literally changes everything. Now, if you do end up renting it out for more than 14 days, things get wild. This is literally a choose-your-fighter scenario when it comes to allocating your expenses. You've got the IRS method versus the tax court method. The IRS method allocates your interest and taxes strictly based on the ratio of rental days to the total days the home was actually used. But the tax court method, it allocates those expenses based on rental days to the total days in the entire year, so 365. The tax court method often lets you keep way more of your mortgage interest for your personal itemized deductions. And get this, taxpayers can generally just choose whichever method is most beneficial to them. But wait, it gets trickier. What if your rental expenses end up being more than what you actually made in rent? You can't just claim a massive loss and wipe out your other income. You have to strictly follow this three-tier sequence. First, you deduct Tier 1 expenses, which are things like advertising plus your allocated interest and taxes. Second, you deduct Tier 2 operating expenses, utilities, repairs, but only up to whatever rental income you have left over. Finally, Tier 3 is depreciation. The absolute golden rule here, Tier 2 and Tier 3 expenses cannot create a net loss. And here's how all that theory actually looks on paper, turning a really complex vacation property into an official IRS Schedule E declaration. You can see right here how the Jeffersons have to map their rental income against those direct expenses, the mortgage interest, and the depreciation. Notice how those cascading tier limitations completely protect the IRS from letting someone's personal vacation home turn into a giant, unfair tax shelter. Finally, let's wrap up with Section 5, claiming the home office. Okay, so Jasmine is setting up her graphic design business in their new Chicago basement. The absolute biggest trap here? 2 words, exclusive use. If you want to claim a home office, it cannot have mixed use. If Tyler sits down at Jasmine's desk just to surf the web or check some sports scores, the IRS says that space is completely disqualified. I mean, one actual real-world tax court case. A taxpayer tried to claim the bathroom adjacent to his office as part of the deduction. But because his kids and house guests occasionally used it, the court denied the deduction. Seriously, lock the door and keep the key, or the IRS is going to disallow the whole thing. So when it comes time to file, Jasmine has a choice to make. She can either meticulously track every single utility bill under the actual expense method or take the easy route with the simplified method. The actual method lets you deduct a percentage of electricity, gas, and even home depreciation. This gives you a higher deduction right now, but it lowers your home's tax basis, which risks a nasty tax hit when you eventually sell. The simplified method, you just take your office square footage up to 300 feet and multiply it by $5. Boom. A quick $1,500 deduction, minimal math, and zero effect on your basis when you sell. So, as we've seen with Tyler and Jasmine, mastering the tax code can literally save you hundreds of thousands of dollars, but it is a total tightrope walk. From grabbing that $500,000 exclusion to making sure one single vacation rental day doesn't blow up your entire tax strategy, the stakes are incredibly high. You now know the rules of the game, so ask yourself, are you prepared to play by the IRS's rigid rules to build your wealth? And is the tax break really worth the risk?